everybody. My name is Natasha Phipps. I am the CEO and co-founder of WealthShare Real Estate Investment Trust. And tonight we are talking about passive investing and what that means, how you can take advantage of it for you as an investor here in Canada, and also what WealthShare is up to and what our 300 plus investors are doing with WealthShare and what is next for us. So we are really excited to move into a bit of a growth mode for WealthShare now that we have our first few years behind us. But yeah, we will talk more about that as we move along here. Okay, before I do get started, I do need to just quickly do a quick review of our disclaimer. This is available on our website at wealthshare.ca. And anything we do discuss this evening is not a solicitation for your investment. It is for educational purposes only. And if you do want to review this disclaimer, you absolutely can on our website, like I mentioned. Very fun stuff. Anything we talk about in terms of numbers or projections, strategy, that is all forward-looking information, of course, not guaranteed. If anyone is guaranteeing you anything, that is a question mark you should be asking yourself if that is the case. But anything we're talking about here this evening is, like I said, for informational purposes only. So I always like to start really quickly about who we are and being dialed into who the WealthShare team is, who our investors are, and who we are at the core. I think if you're looking at WealthShare or any other fund, the first question you should be looking at is who are the people behind it, and does what they are saying or their strategy resonate with you? So who are we? We are a private real estate investment trust located here in Calgary, and our mission is really to provide as much opportunity as possible to Canadians to invest passively here in Canada in multifamily assets. Our values are really critical to everything we do, every decision we make. These are the three things that we always come back to, which is transparency, accessibility, and education. I'll talk more about transparency when I get to the structure and why that's important to you as an investor. But accessibility and education are also really important components for us. When we started this about 4 years ago, or started to look into this about 4 years ago, most of the funds out there with this structure and in place were reserved sort of for the already wealthy in this country, to be quite honest with you. They had very high minimums. It was sort of like you had to be invited to be in the crowd, especially on the private offering side. On the public side, because you can invest in things like REITs, obviously on the public exchange, that's a whole different thing. Of course, anyone can invest on the public exchange, and that's a very different type of investment, which I will talk a little bit more as well. But in terms of the private offerings in Canada, historically, they've kind of been hard to get into, if you get what I'm saying. So we wanted to really flip the coin on that. We wanted to make real estate investing as accessible as possible. I've been an investment focused realtor for 18 years here in Calgary and have helped hundreds of people build up a portfolio of real estate over the last 2 decades. But what I'm seeing out there, and what we're all feeling, is it's getting harder and harder to do that. It is not easy for a lot of Canadians just to own their own home, never mind a portfolio of rental properties. And so we want to be the opposite of that. And I would say our investors fall into 2 different buckets. One is maybe brand new to real estate investing passively, or real estate investing at all, which is sort of who this evening is tailored towards. They like the idea of real estate, but they don't necessarily have the experience yet. So we offer a good pathway to invest in real estate with as little as $5,000 and get started. That, when we were starting, was sort of unheard of. There's many groups out there now doing that, but when we got going, that was not something that was commonplace out in the market. And we really believe if people start dipping a toe, start paying attention to their finances and learning, that we're all better for it here in this country. So that's our 3 core values: accessibility to opportunity, education, and transparency. And then our second kind of bucket of investors tend to be people who love real estate. They know real estate inside out and backwards, but they know 2 things. One is they cannot be good at everything. They cannot be diversified into everything, but they do want to be investing into hard assets here in Canada and love Alberta and love what we're doing with the fund. And also, the big one is being able to use registered funds. So, investing with your TFSA or RRSP or RESP or LIRAs is something you're not able to do in Canada into your own hard assets. So, if I want to go buy a property, I can't use my own registered funds to do that, but I can use my registered funds to invest into something like WealthShare. And so those kind of, core two groups of investors is who make up our about 300 investors today. And it's pretty evenly distributed. And we have an excellent relationship with both of those type of investors. So really quickly, just who is our team and what are we all about and how did we come together to form WealthShare? The first three names here are myself, Rodney Phipps, and Monique Verland. We are the initial founders of WealthShare and also trustees of WealthShare. And we're also joined this evening by Michael DiPaolo, who's the head of our investor relations. And Michael helps us with all of the day-to-day things related to our investors on processing investors, helping investors with any questions they may have as the year goes on. But really importantly, I want to highlight two things. Myself, Rodney, and Monique have all been investing in real estate for decades before kind of coming together and forming WealthShare. So we do have significant experience in Alberta as landlords, as investors, as property managers that we bring to the table. And then the three names at the bottom I want to point out. So if you're new to this sort of passive investing space, or you're looking at other funds like us, it is important to think about who are the trustees and what does that mean? What are trustees? So in our case, we have 6 trustees and we meet quarterly, kind of like what you would think like a board of directors, but we're a group of trustees. And any major decisions such as acquisitions, selling an asset, refinancing, large strategic decisions are made by the trustees. So this is really, really critical because, again, these are the people making decisions in terms of where our investors' money should be going. And so it's important to think about who those people are. So who do we have here? We have Sean Wilson, who is a entrepreneur, has built several startup companies here in Calgary. We're very grateful to have his experience. Eve Gay is experienced on the construction side of things as a owner operator of a large construction company here in Calgary. And then the last one is Kyle Hampson, who's a lawyer in Ontario. And so the goal of a group of trustees is ideally that we all have a little bit of different experience that we can bring to the table. And so if you're looking at any other groups out there, look and see who are the trustees. If there's only 1 or 2 trustees, that is something to consider, right? Because these are the people who are making your decisions. And Sean and Kyle are independent trustees. They're fully independent from us in any way. And so that's really important as well. So just want to kind of shine a light on how important trustees are in terms of how your money is being invested, managed, and so forth. Because I think oftentimes people think it's just maybe me making the decisions or Monique or whatnot, and that's just not the case. Okay, so if you are looking at WealthShare or something like us, usually you're going to come across REITs. A REIT is a real estate investment trust. Now, what does that mean? There is private REITs and public REITs. And obviously, we're a private REIT. We are not publicly traded. And there's pros and cons of being publicly traded or being private. We are private. And what that means, though, in terms of what this vehicle does, is it's just a vehicle to pool capital towards a goal. Our goal in this case is multifamily real estate focused here in the prairies, here in Alberta. But there is all kinds of strategies out there that you can use this vehicle for. Now, the nice thing about it, when you combine this with what's called an offering memorandum, we can accept investment in those smaller chunks like I was talking about. So in combination with a REIT and an offering memorandum, or OM, it means we can accept investment from accredited or eligible investors. At the end of this presentation, I'm going to pull up our guide and I'll dive more into accredited and eligible and what that means and why it is maybe the most important thing to to learn about if you're new to this passive space. But this vehicle is what allows for the registered funds to be invested into our portfolio. It allows for not just allows, it requires annual audited financials. So we have independent audits every single year that are critical to you as the investor to get a good look every year as to where the dollars are going, how returns are made, and that they are actually true returns. They are not our opinion. They are independently audited and a result of that. And then also a vehicle like ours is registered with the Canadian Securities Administration and the Securities Commission in each province that it accepts investment from. So what does all that mean? That just means that there is a lot of oversight and compliance in terms of operating a vehicle like this. It is not light on the administrative work, and for good reason. We are obviously investing Canadians' retirement savings funds, their cash, and it's important that there is a lot of oversight. So this is something that should be a highlight to you as an investor. Now, if you're comparing private REITs and public REITs, of course, are more liquid because they're publicly traded. You can come in and out daily if you want to. On the private side, that is not the case. Now, the pro of that is it's not nearly as volatile or emotional as the public markets, but you're not going to see the same level of liquidity or access to your capital if you went and invested it into a publicly traded stock. So that's one thing to kind of consider as a difference. So what are some benefits to you as an investor if you're passively investing into a REIT like us, period? Now, the first one that becomes quite interesting, and you can speak to your accountant about this, is being able to invest your registered funds. And it's something that a lot of investors who want to buy their own real estate can be frustrated with, is that you can't use your own registered funds to buy your own real estate. So this allows you a way to decide where your registered funds are being invested. You can invest them into, storage, into seniors housing, into multifamily real estate, into whatever you're interested in. And then, of course, that does provide some tax efficiencies that you can start planning in terms of how to invest your registered funds and to maximize them, and then how to one day start actually liquidating them or redeeming them as you approach retirement years. So there's a lot of efficiencies that you can benefit from by looking at this vehicle. And it also allows you to have that control of what you want your money invested in terms of seeing where your dollars and cents are actually going. Number 2 and 3 is a big one. As I mentioned at the very beginning, a lot of REITs, when we were getting going, were really reserved for people with like large amounts of capital, which is great. But I believe strongly that investors in Canada don't necessarily need to have hundreds of thousands or millions of dollars. And so being able to access these larger opportunities, to pool capital towards a common goal while being able to kind of see, feel, and touch the assets that you're investing in, I think is a real sweet spot for an investor. The last one there is maybe the most important thing if you are kind of new into this passive investing space, which is diversification. Being diversified across asset type, across location, across investment timelines is really important. So I'm going to take a moment here to kind of expand on this. You can invest, passively inside of developments. You can invest in mortgages. You can invest in all kinds of things. And what I would really strongly recommend is, if you have, let's say, 100,000, maybe you're going to divide that up into something in the East or something in the West, or maybe across different strategies like a development project or a buy and hold opportunity like us. But it's important to be diversifying. And thinking about what you may already have in your portfolio, what can you maybe not do on your own? And you can take advantage of that with something like us. The thing about the timelines as well, the reason I also bring that up is we often get compared, or when you start looking out there, you're probably going to discover a lot of development funds. And development funds are, they're raising capital to do some type of project. It could be a suburban project, it could be a tower, it could be a commercial project, but regardless, they're raising money, you're going to invest, and then you're locked in until the project is done or sold or finished or whatever the exit strategy was. And those development funds, that is a different type of investment for a couple of reasons. Number one is you don't see any growth in your investment during the course of your investment. You realize all your returns at the end. So if that means 5 years, 7 years, 10 years, however long it takes that's how long your investment is locked in. And then also they're not doing most likely annual like valuations or appraisals. So you're not seeing like that growth in your investment during that period of time, which could be a pro or a con, depending on what you're trying to do with your net worth right now. So being diversified is really what it's all about. The most successful investors I've ever seen with the largest portfolios focus a lot on diversification and kind of set it and forget it type of investments when it comes to real estate. But being able to think about those timelines is really important as well in case things come up in life, right? We want people to invest with us for the long run, but things happen in life. And one nice thing about our offering is that there is a route or pathway to redeem. And that's often not the case with those development funds. So just be aware that there is very different timelines and exit strategies depending on the offering out there. Okay, I'm going to talk about multifamily and why, as an investor, to invest passively, why Alberta in particular is so interesting for multifamily. But first off, why multifamily, period? As an investor, if you know real estate, residential real estate and jumping up to multifamily, there is a very different way that you make returns and also a very different opportunity, which I really love. So let's review that quickly. Number one is the difference in multifamily or commercial real estate around how a property is valued or what it's worth depends on the net operating income with the cap rate that is being used for an area. So what that means is the better job you as an operator or we as an operator do in ensuring there is as little vacancies as possible, being really mindful of expenses and really optimizing your net operating income every month and every year, that is a direct result of what your property is worth. Whereas on the residential side, if we're talking about our home, my home is worth most likely closest to what was sold most recently nearby, right? And so you're really at the whim of the MLS when it comes to residential real estate. But what I love about commercial multifamily real estate is the value is very much a result of how good we do our job as an operator. Sure, there can be challenges or benefits in the market at a given time, but you can see pretty well out there who, as an operator, is optimizing on the daily and is really taking care of things eyes wide open. So that's a big one. And it's important to remember too, on the asset valuation side, even small dollars really add up, like parking fees, pet fees, mitigating expenses as much as possible. All those things increase value of an asset. And then that valuation directly results in, of course, financing opportunities. So you want to be really clear on the above. And then financing opportunities in the multifamily space is very different than residential as well. I like to highlight this because a lot of people are hearing about the CMHC MLI Select program right now. It has been sort of a thing that's been marketed a lot to investors over the last few years. And though we do look at every financing opportunity for every asset, we also don't believe in, over leveraging or pushing the limits of an asset in terms of what it can do just to, do so. So we analyze all of the financing opportunities. We actually just sent a project over for underwriting last week, and we got 4 different financing options. So we're looking at all of them. And it is very different on the multifamily side, because those financing numbers are a result of the rental income, of what's projected for income and expenses, like I said, on the valuation side of things. So very different world when it comes to financing, but that's our job to manage. Obviously, one benefit of investing with us is you're not having to get the financing, you're not having to guarantee the loan, and you're not also having to, of course, do any of the property management, but you're still getting exposure to this asset type. Economies of scale in multifamily, I sort of obviously touched on it, but they are really important. So as we grow, as our fund grows, why this is important for you is a lot of times people ask, well, am I just investing in this one building, or is it the whole portfolio? And the nice thing about a fund like this is if you invest now and say, in 10 years, there's however many more assets, your investment is a result of the entire and growing portfolio. You don't have all of your returns set on one piece of real estate in one community in one street, right? So as we grow, that's really important to you as an investor and reduces risk on one asset doing really well or one area. So those low risk efficiencies as well and economies of scale become even more exciting as the number of doors we have grow, and even things like insurance costs that really come down when you see those numbers scale. Last item there, this is something that a lot of individuals are worried about in the last couple of years, which is, what is our money doing right now with inflation being so high over the last couple of years? And a lot of the conversations we're having with people interested in WealthShare is, it's not just about earning returns, like that's awesome. It's also preserving the capital that we have, and hard assets and housing are, historically an excellent way to do that. And so given the state of the world, housing will always remain something that people are looking for. We need to be strategic about it, but those hard assets are a great way to ensure our capital is stable, it's safe, it's growing, and it's invested into something that we can see, feel, and touch. Okay, so if we're brand new to real estate investing, I'm going to spend a little bit of time on this. So where do returns come from in real estate? And most of this is the same whether you go and buy the real estate yourself or you invest in something like us. There is no really secret sauce out there when it comes to real estate. Real estate should be boring, it should be predictable, and it should make returns across these four, but there's five things here. So the first thing people always think about is cash flow. And that is one of the return streams in real estate, is cash flow. And it's usually the first thing people think about. And it is important, but it is not the most reliable actual source of returns. Cash flow is important, but it does kind of come and go here and there, month over month. What my favorite part of real estate investing is the debt pay down here on the bottom corner. So debt pay down is just over time in an asset. The debt is going to get paid down by the tenants or by our customers as real estate investors. And you can see over time what that mortgage balance is going to do. And real estate remains unique in that sense, where we can borrow or leverage the bank's money to make returns off of our real estate, right? So the return on investment in real estate is often so predictable and stable because we are leveraging the bank's money to do so. So that's what does make real estate very unique that way. And it's very obviously predictable 5-10 years down the line what the mortgage balance is going to be. So very reliable source of returns. Now, passive appreciation is something we're all very familiar with, and this could go up or down depending what the market is doing. If you're seeing growth in the market or if it's coming down. Now, what I will say about this, because I know there's a lot of uncertainty out in the world right now, is I've analyzed a lot of real estate and a lot of markets, and you have to be thinking long term with real estate. And if you look at almost any market in this country and take a snapshot of at least 5 years, but let's say for sure 10 years, you're hard pressed to find a time that was like, oh my God, I absolutely should not have invested in real estate. So that appreciation needs to be looked at over time. It cannot be looked at in a tiny snapshot of like 3 or 6 months, because you are going to see ups and downs, even, year to year. So real estate is a long-term game. It should be looked at that way. Even passively, you should be looking at it like an investment. You're going to set it and forget it, whether you're buying the real estate or you're investing with us. Set it and forget it. Buy in good areas that are going to be in high demand for the long run, and let the property do its thing. That's it. There's not much secret sauce beyond that. And all of these things combined are how we make returns in real estate. Now, in the multifamily side, I want to highlight value add here, because if you Google value add or multifamily real estate, you will often see big projects like, having to turn, maybe an 8-plex into a 16-plex or something, a big development. And what's really interesting in multifamily real estate is value add doesn't necessarily mean large renovations. It can also mean those operational improvements. So things like maximizing rents, maximizing things like, we've added storage lockers, for example, to one of the assets, or can you add parking? What can you do to increase revenue that are small little tweaks? And what I will say is every $50 of tweaks that you can make can add up to over $20,000 of valuation on an appraisal. So every dollar really truly does matter when it comes to being able to provide those solid, steady returns to you as an investor. And you need to trust that we're doing our job on that. And this is something that I know we do incredibly well, because we do all of the management in-house. So value add can also just mean, little things, which is what I wanted to highlight there. Now, the refinancing is something that a lot of individuals come across as well when they start, researching real estate. And at the end of a term of a mortgage, you may have an opportunity to refinance the debt that you had on place. So you've paid down X amount of debt, and now you're going to refinance to access maybe some equity. And that can be, for something like what we're doing, really attractive to provide cash distributions to our investors, or to grow the portfolio, or what not. It might change over time. And this is part of what the group of trustees would be evaluating at the time. Given we've only been doing this for 3 years, we have not refinanced any assets yet, of course. But down the road, that will be part of the picture as we are kind of putting this all together in terms of how the returns are made. Okay, so I think we'll be, remiss if we don't talk about why invest in Alberta. And I know there is a lot of volatility out in the world right now. There is a lot of fear and concern, but I do think, in speaking to investors across this country, that Alberta does remain a market that people are interested in and feel strongly about, will kind of remain stable as it can be right now, and is worth putting their money into. So why is that? Let's kind of, talk about that. So in recent years, Alberta has definitely been a kind of beacon in Canada for Canadians to move to. And why are they moving? Why has so many Canadians been moving? They've been moving because number one, affordability. They're struggling to make ends meet in other markets in Canada. And their dollars just go further here. But also we have higher wages, lower cost of living, less taxation, and all of those mean more dollars in the pocket at the end of the month. And that has been something that Canadians have really been struggling with and trying to prioritize in recent years. And when you combine that with an economy that has been focused on diversification over the last few years, particularly here in Calgary, what we're seeing is really good job opportunities. And so we have strong migration. We have people moving here. Real estate is a game about following the people. So follow the people and then follow where they're going to work. And those are the two first things that we always look at. And so in Calgary specifically, but Alberta as a whole, what's been, historically the largest knock people have on Alberta is, well, it's a one horse town. It's all about oil and gas. And yes, oil and gas, of course, is a huge part of our economy and is not going anywhere. What has given me a lot of comfort as an investor over the last 5 years especially is the amount of diversification we are seeing, the growth in tech, healthcare, finance, logistics, shipping and receiving. We're manufacturing airplanes east of Calgary. We have a drywall plant going in. We have a huge flour mill going in just south of Red Deer. These are all things that are kind of unique for our province, but is good to see that investment coming into our province and these companies wanting to call Alberta home. And we have a very qualified workforce. So open for business, will always attract people. So all of those things combined. And then lastly, of course, like we have room, we have lots of space to develop here. We're not landlocked like Vancouver, for example. So as we grow, there's a lot of room and land for not just people, but for business. So that's been really exciting to see. And I mean, I've been joking the last couple of years that it used to be the price of oil was what we talked about every day for as long as I can remember. And though it still comes up, of course, just more often than not, I'm hearing of innovation and stories and things that are not related to the energy sector, and people doing really amazing things here. So that's really exciting. We combine that with quality of life. And quality of life, I think, since COVID has been something on the forefront of more and more people. And it's a reason why a lot of people move here. Being close to the Rocky Mountains and the lifestyle that provides is important. So, and then the very last piece here is rental market regulations. As a property manager, this is the most important thing on this chart, not just as a property manager, but also in being able to protect your money and to protect your investment. The rental market regulations and the legislation in place in other Canadian provinces directly puts investor money at risk. And, we can argue what's right. And I do feel Alberta has a very fair regulatory field, but that is the bottom line of it. If we cannot protect our assets in which your money is invested in, how can I be confident that we can deliver the returns that we can? And so being able to deal with problem tenants swiftly, you can get a hearing in a matter of a few weeks here with a judge. If you have a problem, someone not paying rent, someone doing shady things, whatever it is. So that alone really impacts your results as a real estate investor. And then also no rent control. I mentioned briefly about the CMHC MLI Select program. And one reason why for Alberta, it's like you really have to be sure you want those terms is because to get the full MLI Select that you hear about, you do have to basically agree to rent control. And that's been one benefit of Alberta historically. So we're very cautious with that. That's not something we take lightly and would we would evaluate each project on a case-by-case basis. But the rental market regulations, I feel so strongly directly impact your returns and ability to give you a good return. So what is our strategy here? And if you're looking at other groups out there, it should be very clear what the strategy is and what your money is being invested into. So our investment strategy is to acquire multifamily assets here in Alberta. The only other province we're looking at is Saskatchewan. So we are considering Saskatchewan. It has a lot of the same benefits of Alberta. But as of today, we only have assets here in Alberta. But our goal is to really remove as many variables in terms and kind of thread that fine line of good returns with not taking too much risk. And what you'll see out there if you're deciding where to invest your money, and what you should see is the higher the risk, the higher the projected returns. That should go hand in hand. Because often, I'll hear from people go, well, so-and-so's projecting a 15% annual return, or a 20% annual return. And when you look at it, if their strategy has more risks or variables, the return projected should be higher. So if you're looking at a development project, that has a lot more variables than us just buying a piece of real estate that cash flows from day one, right? So that comes back to your diversification. If you're building a portfolio in this space, being diverse across those things. Not one is right or wrong, but you don't want to have all your eggs in one basket, so to speak, in terms of strategy or risk or diversification. So that is our strategy. We know Calgary very, very well. We've been landlords here through the ins and outs and the ups and the downs and all of it, and know very well where we're happy to be landlords, and know very well where we are not, and that we hold pretty firm to that. And we want to be landlords in areas that we know do well, regardless of what is happening in terms of some ups and downs in the economy. So we're looking for turnkey as much as possible. That doesn't necessarily mean brand new construction, but turnkey-ish. If we've acquired 2 foreclosures now, so that would sound like that's not turnkey, but they were newer assets that really just needed to be managed better to really squeeze a lot out of them in terms of returns. And so good areas, good assets, they're going to attract good quality tenants. That's really what we're doing, and focused here in Alberta. We really want to be the go-to people here in the prairies. So let's take our summary, and then I'm going to jump to our guide and then and any questions, but I want to take our summary of who WealthShare is and use this as an example of what you should be looking for if you are looking at passive investments like us out there in the marketplace, and how you can compare them. So the very first one says it's open to eligible and accredited investors. So for you as a passive investor, there is legislation in Canada and per province related to raising capital in this space, and also investing in this space. So the first thing you need to learn about yourself, if you don't know, is are you an eligible or accredited investor? And this is not something that you go out and get a certification for. It is a result of your net worth or your income. And if you're not sure which one you are, you can easily Google it. It just defines really honestly how much risk you can take and still be able to recover if something goes wrong. And it's really important that people understand this, because if you've been looking at any of the bad news out there in the last couple of years related to real estate investing, 99% of those bad news cases, this was not being followed. So if you're investing with someone passively, I don't care how it could just be peer-to-peer even, this should be coming up. They should be asking you if you're aware of these terms, if you know what they mean, and if this is a suitable investment for you. Any high risk options out there are reserved for accredited investors only. And this is something that I don't see enough marketed or talked about out there in this space. So we spend a lot of time on this, and it's an important one to be understanding and learning about. And it's an easy one. If you're talking to someone, this doesn't come up, then they're actually not diving really deep in terms of compliance and what matters when it comes to raising capital. So we can help you with that as well if you're not sure. Now, the second one here is when you're looking at passive investments, do you have cash or registered funds to invest? This right away can, and in combination with the first one, can really shrink your list of opportunities and help you determine which one makes the most sense for you. So now you can also invest both. We have some investors that have some cash and then some registered funds. You can do a combination. That's okay. Also, what is the minimum investment? And if a fund accepts investment from eligible investors, they're most likely using an offering memorandum. And so the minimum investments can be lower. So ours is $5,000. So that's our minimum. You decide what number you want to invest. some offerings out there, it's a good question to ask, is they won't take like random numbers like 12,600. They want, round numbers or whole numbers. We don't care. It does not matter to us. And we find a lot of Canadians have what I call random amounts in random accounts, where they'll have a TFSA that they put some money in and forgot about who knows how long ago. And they're looking for somewhere to place it. So we can 100% take that money, get it to work for you. And one big note is it doesn't trigger a tax event by investing it with us from wherever it's coming from. It stays as registered the entire time. If someone is convincing you to cash out your registered funds and then invest it, red flag as well. It should stay registered the entire time and not trigger a tax event for you. If you want to invest your registered funds, there is one large main difference that you'll have to research or learn about. And what it is there's an intermediary trust company when you register or when you invest your registered funds. Most people are familiar with Olympia Trust. They have probably the largest market share out there, but there are others. We are approved through Olympia Trust, Odyssey Trust, and Western Pacific. And this is important to you as an investor because this is another set of eyeballs that have approved what we are doing. They have made sure that we're compliant. They are another set of eyeballs for you as the investor. And so what they do is they ensure that we are a suitable place for registered funds. And so there's a whole process you have to go through to get approved. And that should be important to you as the investor. And so, but they ensure that your funds stay registered through the transfer, and also that we are an acceptable place to place your registered funds. So that is the largest difference when you're investing cash or registered funds. When you're investing cash, there is no need for the trust company. It goes directly to our EMD, which I'm going to talk about next. But if you have registered funds, it can take a little bit longer. Not uncommon if it takes, up to 6 weeks to transfer money from whatever institution they're at over to WealthShare or some other offering out there. It takes a bit of time because, as you can imagine, those entities do not want to lose your money either. So just keep that in mind. You will need a trust account with one of these companies, and they tend to charge you about $135 a year to maintain an account for you. And that's something you definitely want. So that's the only fee to invest with something like WealthShare, but I like to highlight it because it is also, I just noticed I did not update our unit price on here. So apologies, our unit price is now over $13, but that is what we'll talk about next. So we talked about how the returns are made in real estate, but how does that actually translate to you as the investor on an offering like this? The returns are made two ways with a fund like WealthShare or others. It's all the same. So we'll take the portfolio here and use it as an example. So you're investing into the portfolio. What you get annually in that independent audit is we're required to do appraisals on the assets every single year. So another oversight that's important. And so that appraisal combined with the audited financials that we talked about results in a net asset value or unit price. So I do apologize. This should say 1320. But I have it as 1250 here. We just adjusted our price last month. So my fault. So this mostly translates to what you'd be familiar with in a stock price or share price. So that's one way that you get returns. So our investors that invested with us from day one, our initial unit price or stock price was $10. So if they invested from day one, now they've made over 30% on their investment in terms of equity growth or unit price growth. So in long-term buy and hold real estate, that's the most sort of kind of predictable way you're going to see returns, because over time the debt pays down, we see appreciation, it does its thing, right? And so what's cool about that is you do see growth in your investment year over year. You get your report, just like you would with an investment with, your institution. The other way you get returns with someone like WealthShare or us is through cash distributions. Now, cash distributions, we have not done any cash distributions yet, but we also did not project any in our first 3 years. Getting this company off the ground, of course, as you can imagine, it takes a few years to get things going. And so we didn't project any. As we move forward, especially past year 5, we do expect that to change. So annually, we're targeting a 12% annual return. And some years that might be made up of, 8% growth on the unit price and a few percent on cash distributions. It might vary year over year, but we target 12% total. That's our goal. We've been able to maintain just a little bit less than that so far in our first few years. Our first year, we had about just over half a year in operations. And so that's something we're quite proud of, is a few years of double-digit returns. But as you can see here, this is the type of assets that we are looking for. We're not looking for, assets that don't look desirable. We find good tenants stay longer. They take care of the property. They're easier to manage. And in areas that you might pay a little bit more than other areas, but these are areas that will always be desirable no matter what the market is doing. You can find more information on those as well on our website. So just a quick review, why invest with us? The 3 most common things that kind of stand out is the low minimum investment. It's very accessible. The team behind this is something that I've heard time and time again, our investors love. We make ourselves very available to our investors. Being a small company, it's easy to do that. And we are here to help you and support you along the way. We're building a really cool community here and are looking to grow. And so we target 12% annualized returns. I'm going to talk real quickly about an exempt market dealer and what that means. And then I'm going to pull up that slide, but I did want to highlight, we have passed our 3rd full year of independent audited returns. So what does that mean? If you want to go and check out our 3 years of audited financials, you can. And I recommend you do that. And I recommend you do that for other companies that you are looking at, so that you can take a look at what's actually going on under the hood. So there's 3 years of audited financials available for you and 3 years of track record now. And the last thing I want to point out is, what is an exempt market dealer? If you are new to this passive investing space, I know there's a lot of new terms and a lot of things to remember. We talked about the suitability of accredited and eligible investors. The other one to really remember is exempt market dealer, or EMD. So what is that term and why does it matter? An EMD is there to ensure that we are compliant, and they're also there to process investors and make sure that they're investing in something that they understand, that aligns with their risk, a tolerance with their goals. And our exempt market dealer is called Atlas One, that we have been working with since day one. They're actually just undergoing a large merger with Parvis here in Calgary, or here in Canada. But Atlas One will also remain our team, but they may get a new name. So what is their job? Their job is to ensure that it's a third party answering your questions. They're there to ensure that we are compliant and doing all of our filings right, and are there for very good reason to help you through the subscription process and through any questions that you might have. So why I like to point this out, though, is if you go on the Atlas One platform, and maybe Michael or someone can put a link to our offering on Atlas One in the chat. But yeah, if you go on there, you'll see a bunch of other offerings as well. And you can kind of take what you've learned here this evening and through our guide as well to kind of, compare what's out there, see what makes sense for you, what aligns with you. And then also you can reach out to their team on there as well. But I kind of call Atlas One like the Amazon of private securities. And it's not all real estate. You can invest in music royalties, for example, which is a really cool one, and all kinds of different strategies and projects and locations and things. So I highly recommend checking it out. And Michael just put a chat. Okay. So just real quickly, just to review what the process is in investing in something like us and what the process looks like. So for us, Atlas One is our exempt market dealer. Other groups may have other exempt market dealers, but regardless, you need to make a profile on the exempt market dealer site. Ours is Atlas One. You just need a name and email to make a profile. What I recommend you do after that is whoever you're looking at, you review the offering memorandum, you review their financials, and you can also review, if you're ready to invest, the subscription agreement that you're going to be signing. And these are large documents. They may be a lot to go through, but they're all there for you to review. So I recommend that you do. I recommend that you ask questions if you have them. That's what the team is there for. And on these platforms, you can also submit your investment as well. They make it really easy. It's, kind of click submit, it's DocuSign, and they will also help you through the process every single step of the way. We have investors who do this monthly. They do monthly investments into the offering, but you do need to do a subscription agreement for every investment that you do. And then the last thing I'll say about this is if you want to ever download your statement, see what your investment is worth, it's kind of like a little portal as well for your investment that you will have all the relevant information that you will need in terms of seeing what's going on with your investment. So it's kind of a cool platform that way. And yeah, we kind of reviewed all of this. Oh, one thing I'm going to highlight that's important to learn before I pull up the sheet real quick is issuer fees. So if you're comparing us to other groups, one thing to think about is who actually owns the real estate and how does the management team get paid. So in our case, our investors own 100% of the assets. So I don't have a chunk set aside for myself. We are here to manage our investors' investments and to manage the fund, but we are not taking a big chunk of it for ourselves. So the worst case scenario happens, which is always important to think about. What would happen? And we would sell off the assets, the debt would get paid, and whatever is left would go to our investors. And so that's not the case everywhere out there. So look at this one real closely in terms of who owns the real estate. And then also really important is called issuer fees. Now, when you see the word fee in this passive investing world, it doesn't necessarily mean a fee that you're paying. This in our case, this is a cost of operations. So how do we get paid as the management team, considering we don't have a chunk of the assets for ourselves? So this outlines our fees. So if we do an acquisition, we get a 1% acquisition fee, financing, refinancing, and we get an ongoing 2% management fee. The last component here, which is really what's in it for us in the long term, is if we hit a minimum 8% preferred return to our investors and there's cash distributions that year, then us as the management team do get a 20% performance bonus for that year. So that's all outlined in the offering, though. You can go review it at any time. It's openly disclosed. But this section here will change a whole lot when you're out there looking at other options out there. So compare the issuer fees now, and please keep in mind that our targeted returns, we don't take fees off after that, like you might see with your large institutions. So your returns are your returns. We don't charge you fees, but we do, of course, have operational costs to manage everything, year over year. And then the last one is dealer fees. What does that mean? So we have to disclose to investors, not just us, but everyone that does this has to disclose what kind of the cost it might take at a maximum to bring capital in. So as you can imagine, there's fees for the exempt market dealers, for the capital raisers out there who introduce investors to us. And so you have to outline what a maximum is. I don't think we've ever paid 6% for funds coming in, but that is the maximum that we are allowed to pay as outlined in our offering memorandum. So this number also changes quite a bit out there. So two things to look at if you're comparing is where's your money actually going and how is the team actually getting paid? Okay. Any
Yeah,
question? Yeah, go
I was
ahead.
just gonna add to that, or just sort of, I guess adds the best word, but it's really important, and I'm just reiterating that, like, dollar for dollar, your dollar represents your investment. So even on that 6%, we have to disclose that up to 6% of funds raised, but that doesn't come out of your money. Your dollar represents $1, and then your returns represent a dollar. So sometimes people will look at some of these management fees and things like that, and compared to maybe you have a holding with the major bank or something, they'll sometimes just like go, okay, well, you did 10%, but then there was the management fee that came off of that and this other fee, and then your actual realized return is maybe 6 or 7%.
Right.
With us, your return is what you get. We have to disclose these things because we're a private security and we want full transparency. But at the end of the day, it's not less your return. So when we announce, our returns for the year, you don't have to now subtract that 1% there or whatever. Or if you say, okay, we're having up to 6% cost to raise capital. If you invest 100,000, your return is off of 100,000, not less any fees.
Yeah.
So just like to always confirm that because it's a
Mhm.
lot and it's not always the same. Not all
Well,
offerings are created equal.
and it's a good thing to point out as well for when you're reviewing your own like investments you have now, is looking at the fine print of what fees you might be paying. A lot of people don't even know they're paying fees, or they don't know what they are. So looking that up, like maybe it hit X%, but really it might be a couple percent lower than what you think when you have funds. I'm gonna pull up this guide real quick. I'm not gonna go through it all, but I want to show you guys um, the guide that I wrote, because a lot of things that we learned, obviously putting WealthShare together, I would not have known. And I've looked at a lot of real estate over the years and have learned a heck of a lot in terms of what.
Maybe
Um,
while you're doing that, I'll just say one thing for where we're at now, which is really exciting. So we're sort of through the startup phase of WellShare. The last 3 years has been us proving our concept. It's what a lot of the institutions want to see: 3 years of return and growth, and that the things that we said we were going to do, we did. So we're cautious but confident now that if we can do that through a pretty interesting and tumultuous 3 years in a startup portion, that we're confident that those things that we've developed are going to pay off in this now growth phase. And we have some really great assets in front of us that now we're raising capital to go purchase. And so for us to now take this fund from the almost 30 million in asset value under management to that interior goal of 100 is going to be really exciting. And I think being able to prove the concept is amazing. But it means now that we've proven it, we can now grow the concept.
yeah, really good point. Really good point. And we take a conservative approach to everything, and that's part of the reason we didn't buy anything last year, not because we couldn't find any deals, but honestly, all the deals didn't make sense. So we're not going to grow just to grow. Like Rodney said, we're going to grow because we want to perform. And sometimes that does take some patience, which is what we've been doing, but we'd rather deliver good, strong returns than grow just for the sake of growing. But now we're in that space. I think if anyone wants to talk about the actual market, I'm happy to do that at any time. I love talking real estate. If you want to bounce things off of me, happy to do that and give you my insights. I know we're at kind of just over the hour here. Really quickly, I want to show you guys this document, and obviously you have the link there. If you're watching the recording, we can send this to you or we'll email this out with it. But I suggest comparing what we are doing to other offerings out there. We love the questions. We invite you to review this and ask some questions when you're out there. And what this is going to go through is it's like basic things that you should be thinking about in terms of knowing your investor profile, who you are, what you're looking for, the timelines. And then what I really want to highlight at the end here is 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 questions to be asking, and like the really key things that you should be thinking about. I think there is all kinds of resources out there for how to analyze active real estate deal, but very, very little. I think our resource was the first one I'd ever seen out in the marketplace of how to actually analyze a passive opportunity. How do I analyze something where I don't actually get to see the real estate, and it comes down to the people and the documents and all the things that you might not know to think about. So that's the point of this document. I'm sure I could expand upon it as well, but this should give you a very good start. And I've already heard of some groups using this out there in the marketplace, which I love. So this will give you actual tangible questions that you should be asking us or anyone else. And we've, reviewed some of those here this evening. But even just as an example, like how do you mitigate risk? How does the management team get compensated? How much debt is the portfolio carrying? All of those things. Does the management team have skin in the game? All those things that should give you a good sense of who you're investing with, how your money is being used, and see how you feel and if that aligns with what you're looking for. So I really hope this helps. And if you have any feedback on it, I would also really greatly appreciate that as well. So that's the document. Okay, well, I will just reiterate that, like Rodney said, we have a good, strong foundation now behind us in the last few years, and we're excited to grow. There are opportunities coming across our table now that make sense. There is opportunities here in Alberta that definitely were not there last year. And there's also, some maybe opportunistic things coming up that are a result of the market being a little bit overheated for the last couple of years. And so that's what we really want to be ready to take action on. We, of course, cannot do it without our investors. And so our goal is to, grow our investment size, our portfolio size, probably, double inside of the next 12 to 24 months is our internal goal. So we'd love for you to be a part of it. And we're always here to help you with anything else as well. Like you need a referral for something, you need something, we help our investors as much as we possibly can along the way. So we're here to connect and we're here to help.
This is only available in Canada?
No. So we actually have investors from outside of Canada. That's a great question. Investors from across Canada. Now, taking in American money is something we're unable to do unless someone has dual residency or an address in Canada. Outside of Canada, we can accept investment from almost anywhere other than the US, as long as the investor meets an accredited status in their country. So we have investors from South Africa and the UK, and so the rules are a little bit different when they are outside of Canada. So we would just have to talk with you one-on-one about that and see. Okay, well then we will leave it there this evening. If you're watching the recording or you're here, please reach out. We would love to connect with you one-on-one and talk more about whatever you guys are interested in talking about when it comes to WealthShare or the offering or any questions you might have for us. We're here to help.